Hello, everyone. Welcome to our discussion of Chapter 15 and partnerships. Partnerships are perhaps the most flexible of all of the entities, business entities that we will deal with outside of um, a sole proprietorship or Schedule C. Partnerships do have more than one owner, but remember that when we talk partnerships from a federal income tax standpoint, we're talking about limited liability companies, limited liability partnerships, limited partnerships, and general partnerships. So we've got several different legal entities that are all treated basically the same way under the tax law, under at least the federal tax law. So it can be a lot of things, decide to conduct business with each other, okay? And again, you can check the box, and there's some ability to choose what you do no matter what your legal entity is. So tax years are usually going to be the calendar year because almost all individuals are calendar year. However, you may end up with situations where the partners are corporations, and corporations often have a tax year that is different than calendar year, and therefore you may have to start talk about what the partnership's required tax year is based on what the partners is. It has to be the same as the partners that have more than 50% of the capital. So, an example, there's not a majority partner. So if one of them was 60%, let's say, we would have to use that corporation's year end, the same for the partnership. If there's no majority, then all of its principal partners, and somebody that's 5% or more. So A and B each own 50%. Since not all have the same tax year, the tax year cannot be determined using the principal partners rule. Okay, since neither one of them is the same, so it can't be determined that way. The last one is that least aggregate deferral, meaning you're not going to postpone taxes by choosing a tax year. You can use a natural business year if 25% or more of your gross receipts are received in the last 2 months for 3 consecutive years. This is basically to use a fiscal year if, for instance, you were a ski resort and all of your income is happening in the wintertime. You would not want to have your tax year end in the middle of your ski season. You'd rather have it end, say, June 30th, so you don't have to worry about all that stuff at the same time as you have your busiest time of the year. To do that, to make that work, you're going to have to be in existence for 3 years. And you can choose also, as long as you do not provide more than a 3 month deferral for your partners. That means that if your partnership with 1231 required tax year, say all partners are 1231, could select a 930, 1031, or 1130 year end because they would not be deferred the income more than 3 months. So the partnership would have income. It would be reported on the tax return for the partners. Now the thing is that those last months of the year, if the partnership has a 1031 year end, then income for November of the current year does not get reported until next year because of the fiscal year, and wouldn't be on the partner's return until the next year. That's what we mean by deferral. If they want to choose with one of those exceptions, you have to get permission. Partnerships, though, do not themselves pay taxes. They simply report income and expense items similar to they provide a K1 that's similar to a W2 that you're familiar with in reporting the income that is earned by the partnership on behalf of the partners. Everything that's treated the same is called ordinary income and is passed through to the partners regardless of whether they actually receive cash or not. So if you're a 50% partner in a partnership and the partnership makes $10, you get allocated $5 regardless of whether that partnership gives you $4 or $6 or $5. Doesn't matter how much cash it is, how much the partnership earned. So this is how you calculate that. This is your ordinary income. Okay. These are the various categories that happened in a business that we would report as part of the business income. Notice guaranteed payments are deducted from ordinary income. That's payments paid to the partners as part of them working for the partnership, you might say. Now, if there are items in expense and credit that are treated differently, meaning that they have special rules, and we've learned a whole bunch of stuff in the first 12 chapters of our textbook that indicate there are special rules for lots of different items, and you'll recognize some of these as we look at the list of separately stated items. These are the items that have to be broken out from the regular business income, and this is because they are treated differently depending on who the tax partner is. So, for instance, one partner may need to know that he has short-term capital gains because he has short-term capital losses personally. Another one has to report the interest income separately because it's taxed differently because they have investment expenses or something like that they need to offset it against. So all of these items must be separately stated on the 1065 form. You'll see that. Okay, it's due on the March 15th if you're calendar year, 2.5 months after the close of your tax year. You get an extra 6 months by filing extension 7004. Now, partnership basis, we've talked about basis in earlier chapters. Just like any other asset, you have basis in your partnership interest or partnership share. Starts with the amount you pay for it and then gets adjusted. And it has important for two reasons. Both, one, when you sell it, you'll use it to calculate the gain. And second, it determines how much you can deduct if there's losses from the partnerships. You can only use it if you have enough partners basis. That goes back to the at-risk rules we reviewed briefly in Chapter 9. So the partnership interest is you add contributions, you add the income or subtract the loss, your share of separately stated items, your share of partnership liabilities, because you're assumed to have to pay those if the partnership cannot, and is reduced by distributions to the partner from the partnership. When a partner contributes cash or other property to the partnership, you basically just swap basis. Your basis in the property you contribute becomes your basis in the partnership share. And your basis becomes the partnership's basis. There is no taxable transaction typically unless the partnership assumes a loan against the property. All right, this is going to be right on the tax return each year, okay? And those are taxed and flowed through to affect your partnership share. And again, just a reminder, you get taxed based on not on distributions, but on how much is earned. This is what a K1 looks like. All right. This starts with business income, and each of these lines, these numbers, are separately stated items. So in a 1065, there's a Schedule K, which is all the partners' stuff, and then it's separated by partner and goes on the K1. Partners' information is here. Their basis is calculated here, kind of in this little section here, and then here are all the separately stated items. Never can have a partnership interest that goes below zero. Okay, if you have a disallowed loss that's going to make it go below zero, it carries forward until you can make up the basis. If you receive a distribution when your partnership interest is zero, you could have a taxable transaction. Partnership liabilities. If you're liable for the debts of the partnership, your basis or your amount at risk goes up by the amount that the partnership borrows. Any change in that will change your basis. Limited partners, however, are not, their basis is not increased by those partnership liabilities unless the partner himself was the lender. So if A and B are general partners, own 30%, B owns 70%, at the end of the year, the liabilities will total $30,000. So A includes $9,000 share of the $30,000. B includes the other 70% in their share of the liabilities. And distributions make it go down. No gain or loss on distribution of property or cash or anything from a partnership to its partners. It's a non-tax transaction, and if there's a distribution of property, then the basis just carries over to the partner from the partnership. There is no change in the basis as it gets distributed. All right, and the current distribution, the definition is so a partner can receive distributions. They're not taxable, but they can't decrease your partnership interest below zero. And if you do receive cash in excess of your basis, you have a taxable gain. So some examples: partner's basis is 10. The partnership is 8,000. Reduces it. Okay, the distribution is not taxable. The basis goes down from 10 to 2. Okay, if it's 2 before it receives 5, then the 2,000 is tax free. We recognize the basis to 0, and then there actually is a gain because we went beyond 0 in the distribution. Basis of the property the same as it was in the partnership's hands. If this amount would reduce the partner's basis below 0, then the basis of the property is the partner's basis in the partnership's interest. So $5,000 is the partner's basis, distributed property worth $8,000. The partnership's adjusted basis of the property is $4,500. Tax-free to the partner reduces the basis by the $4,500 because that's how the amount of the distribution is determined when it's a property distribution is the basis to the partnership. So it reduces it down to $500. The partner now has basis in that property they received of $4,500. Basis is $3,000. Property worth $8,000. Adjusted basis the property is $12,000. So you can reduce it down to 0, but not below that. Okay, tax free. And then their partnership basis in the property becomes $3,000. So there's not a taxable scenario here, but now that the partner has only a $3,000 basis in this property that's been distributed. both cash and property. Cash distributed is treated first, and then the property. You do it in that order. So that wraps up partnerships in chapter 15.